I would like to introduce our guests. We have Becky and Morgan, both from Stride. What are you going to teach us about today?
Cash flow.
Why don't you dive in? Let's see what we got.
Nice to see everyone. Today I'm going to talk to you about cash flow. So Stride is an accounting firm, and we do accounting for MSPs. We manage the day-to-day accounting. We manage the tax prep at the end of the year, and we also manage. We do advisory, cash flow advisory, financial statement advisory. Today we're going to focus on cash flow. I'm going to start with a quote. This quote is, "One of the earliest lessons I learned in business was that balance sheets and income statements are fiction. Cash flow is reality." So really, that's what it is. Cash flow is the reality. If you don't have cash, you can't keep going. Um, so I'm going to talk a little bit about how you can manage cash flow in your business. And so I'm going to talk about cash flow from operations, and then Morgan's going to talk about cash flow, other types of cash flow. So from operations, accounts receivable is, of course, right, the lifeblood of any business. It's where beginning, right? And without cash flow, even the most profitable company can run into trouble. So one thing that's super important is when you're making an agreement with a new customer is really agreeing on the payment terms. And that doesn't just mean, when they're going to pay you. It's really about what is the process of you getting paid in multiple situations. So hardware, you want to get paid in advance for hardware because you don't want to become a bank. So you don't, when you're buying something or you have to spend money on your customer's behalf, you don't want to be putting that money out before you get paid. If you have a monthly agreement, an ongoing agreement with the client, getting them to pay in advance upfront with a ongoing agreement to autopay, that's best practice. That way you're not chasing money every month. You have predictable cash flow, and there's no reason to discuss it because you've already agreed upon it on that price for a certain amount of time. And then for projects, getting paid, if it's going to be a big project or even a small project, 50% upfront, it gives that client a real commitment. They have the skin in the game. And that way you're not out of pocket and you can cover your expenses that come up during that period. So it's super important to, get paid, get cash, not just be able to send a bill out 30 days after you do the work and then have it be paid 30 days later. That's going to hurt your cash flow, and you're going to have problems when it comes to making payroll and paying your bills. Another way to really manage your cash flow through operations is with accounts payable. We see a lot of times that people are eager to pay their vendors as quickly as possible, which is great. However, if a vendor gives you net 30 terms, take advantage of it. Pay when it's due. Don't pay late. Pay it on time, but pay it when it's due rather early. That will save your cash flow for you to do other things throughout that 30 days.
Now, I'm sorry. Now, I've heard when I ran my MSP, I had clients who would always pay me like 10 days late. And it was just another strategy of managing cash flow. So you're saying don't pay late, pay it on time, but don't pay early if you don't have to. What's the benefit to paying a few days late?
Well, the benefit to paying a few days late, the benefit is to the customer because they're getting their cash flow for 10 extra days, right? That's why you would want to have an agreement with them that on the due date, it will auto pay. Okay, so that's more in terms of like when you're making that agreement with them, it's not just about, you're going to do the work and they're going to pay you. How are they going to pay you? And make sure they pay you on time, have a payment method on file that you'll charge in case they don't pay it earlier.
Well, I like that idea.
Yeah. So, it's a way. Go ahead.
I was going to say also, if you're paying late, Steve, oftentimes contract terms have late payment fees. And I know, for example, most professional services will have interest on unpaid balances. So it's not uncommon to see a vendor have 1.5% per month interest rate on unpaid balance. So paying on time is great. Paying early is, cuts into your cash flow.
And if you pay late and then that vendor doesn't assess a late fee, then you're going to keep paying it late because you're paying it. Here's a cash flow tool. I have 15 extra days to pay this vendor because they don't ask me anything until 15 days late. So therefore, I just got an extra 15 days. Where the ones who know that there's going to be a late fee, they're going to pay it on time because they don't want that late fee.
That makes sense.
And so I would say that when you paying bills late, yes, that's a strategy, but you're risking having interest or late payments or ruining a relationship with your vendor. So paying on time is what we advise. But some vendors offer discounts for early payment. Any discounts for early payment, take advantage of them. That's a time to pay early. But if there's no discount, take the terms that they're extending. Yeah. So, so when it comes to operations, really the big triggers that you have is when you collect from your customers and when you pay your bills, when the money goes out the door, right? So getting that control and making sure that they're timed right. So, your payroll, when are your payroll run dates versus when you're collecting cash to make sure that you have the cash to cover the payroll. And just making sure that you're not having to dip into reserves or anything to run your operations, right? Just for the operational work. So I'll let Morgan talk about some other ways that you can work on your cash flow.
Sure. So other than operations, there are a couple other ways to increase cash flow. One is debt. So if you are finding yourself in a situation where your operation cash flows aren't sufficient to cover payroll or whatever, or you just find yourself in a spot where currently cash flows aren't great, but I know it'll turn around down the road, debt is a great way to fill that gap. So think about things like, charging your bills on credit cards, get not a home equity, but a line of credit or a home equity line of credit, but get a line of credit to kind of backstop some of those expenses. You straight debt. So bank debt is another way to get some cash in the door. And then there's lots of other ways. There's factoring your receivables and stuff like that. So debt's a great way to fill cash flow needs. Obviously, debt generally is not great, but it is a good way to increase your cash flow needs in the short term. Some pros of taking on debt. It's easy to get. Interest is tax deductible, and your payments on the debt is pretty predictable. Some cons on taking on debt, obviously, loading up your balance sheet with debt doesn't look good for banks and vendors. And if you're going to sell the company, you don't want a whole lot of debt on your balance sheet. Oftentimes, lenders will require personal guarantees or collateralization of assets. And then, payments are due regardless of whether you have income coming in or not. So, those are the downsides to debt. On the tax side, so I run the tax group at Stride, and on the tax side, we look at, are there ways to decrease my tax liability so that I don't have to put cash out to the Internal Revenue Service for the franchise tax board or whatever taxing authority. So minimizing taxes helps increase cash flow. And then we always tell our clients to always know how much, or an estimate of how much you're going to owe in taxes for that year, so that you know how much of that cash that's sitting on your balance sheet doesn't really belong to you. Ultimately, you'll have to put that cash into the IRS or whatever taxing authority you may be doing business in that jurisdiction. So those are some other things on the P&L side or the income statement side. We look at, credit card fees. If you can pass those credit card fees on to your customers, that's a great way to increase your cash flow. You're not paying their fees. Again, avoiding late fees is a great one. Don't pay bills late when you can, you know, if you pay it 1 day late, if you're for a late fee, that cuts into your cash flow. So, and again, taxes, reduce your taxes, look for tax strategies to reduce your tax liability to increase your cash flow.
And, you know, shameless plug, alternative payments has the ability to pass those credit card fees on to your clients.
Yeah. Yeah. We've seen, you know, we look at a lot of tax returns and books, and we've seen one set of books where they're paying about $50,000 a year in credit card fees. And it's an easy pickup, right?
I mean, that's a salary.
Yeah. It's also a 401k contribution or something like that, right?
Yeah.
That
I mean,
client's alternative payments.
It's a year of college for your kids.
Yeah. I mean, there are so many better things you could take that $50,000 that you're paying in credit card fees. And look, I know not all of you that are here are spending $50,000 a year in credit card fees. Some of you are spending more. No, some of you might only be spending, you know, 5 or 6,000 in credit card fees. Maybe you were smart and you have all of your clients on ACH, or most of them on ACH. So yeah, there are definitely ways that you can save on the credit card fees. I would say ACH is one no-brainer, especially in today's age of technology and the cloud and everything. You don't want to be waiting on checks. That's the worst way to manage cash flow, is to send out an invoice to somebody and wait for them to mail the check and hope it didn't get lost in the mail. Or did they actually mail it? Did they forget? Or are they dragging their feet or whatever, right? That was always, when I ran my MSP, that was one of my biggest fears, was what if they want to mail me a check? Ugh, I'd rather just go pick up the check. Which stinks, because now I'm out, like, you know, an hour because I'm going out of my way to go pick up a check. You just can't
We have a client, Steve, we have a client recently that instituted, so they were collecting checks and, you know, we helped them get off of that. They're now doing ACH payments, and they've now instituted an internal process, if you will, that if you mail them a check, they're going to charge you a $25 fee.
Wow, that's good job. And you know, it stinks to like have to nickel and dime people, but at the same time, like, you know, to process a check, and look, I'm sure I'm talking about you know, alternative payments, but it doesn't matter if you use our platform or not, right? To process a check, it takes additional time, which means you have somebody spending those resources, right? So charging $25 as a convenience charge, or whatever you want to call it, to pay by check, I don't see any problem with that. But you know what really grinds my gears? My HOA, which you already don't need me to say anymore. My HOA, we just built a house in July. It's our first house, which means it's my first HOA. They have a convenience fee for me to be able to pay online, whether it's ACH or credit card. They charge me an extra $3.50.
Criminal.
But I can mail them a check. My bank doesn't even do checks.
That's funny.
Most people don't even have checks anymore.
Yeah, it's 2025, guys.
What's really funny is my 9-year-old son, got a check for something, and he was like, "Can I keep it?" And he was so excited. He said, "It says my name on it." And it was so funny because I had already deposited mobile deposits. So it was like, "Let's see if you have it." But he was so proud because he's like, "I've never gotten a check before." And it's so funny.
That is funny. Good for him. It's like, you know, when you get your first $2 bill. All right. Cash flow. What else you guys got?
How about any questions? Do we have any questions?
Not yet.
Oh,
I mean, the other way to get cash on the door, I don't think it's something that most MSP owners would want to do, but equity is another thing, right? So if you get yourself in a spot where you really need the cash flow and you're willing to sell part of your business to get that cash, that's another way. No, or maybe you want a couple of your employees, your key employees, to be owners of the business. Have them buy into the business. Put some cash in. So equity is another way, but probably not a very common way in the MSP space.
Let's talk about that for a moment. I want to flesh this out. So let's pretend I am an employee at an MSP. Now, in today's day and age, let's be honest, I'm probably making okay money. I'm not like, it's not like I'm flipping burgers at McDonald's, but it's not like I'm the CEO, right? So maybe I only have a very small savings. What are some creative ways employees can get equity? Now, obviously, if the owner's strapped for cash and they need the cash, that this maybe doesn't pertain. But if maybe there's an owner who is interested in giving a portion of the business to employees, or maybe the owner is just ready to retire and they want to find a creative way to give it to one or several employees. How can you do it?
Yeah. So a couple of ways that we see it done is employers could grant the equity to the employee. So I'll give you 10% of my company. The downside to granting equity to Steve is that Steve now has an income pickup, right? So he has to pay the tax man for the tax on whatever value 10% equates to, right? So so that's the downside to granting equity. You could grant equity on a schedule. So if you're going to give 10% to Steve, you could give Steve 2.5% a year over a 4-year period. Again, Steve still has the tax implications of that. So whatever that value is, when Steve receives that 2.5%, he's going to owe taxes on that. And the downside to that is you owe taxes. And secondly, if you do it with a vesting schedule like that, you're going to have potentially an increase in value over those 4 years. So your tax bill may be going up as you're getting that equity. Yeah. The other common way I see people giving equity to employees is they'll give them the equity in exchange for a note. And so it doesn't have the same tax implications because you're not compensating the employee. The employee is actually purchasing the shares from you. They now owe you that money, and you can extinguish that debt via distributions from the business. So that's a pretty common way to get ownership over to your employees. There's other ways too. If the owner wants out of the business, you could consider something like an ESOP, where you're basically giving the company to your employees through an ESOP. So not very common, but people do it. But the two most common ways are either granting equity to the employee or selling the shares in exchange for a note or cash.
Cash is king.
You go.
And if the owner needs cash and the employee has cash, they have leverage, right? It's like they could, you know what I mean? Like, it depends on the situation the business owner is in, right? But if they need the cash and the employee has it, that could be a win-win situation.
I'm sure, Steve, you could even take that note from your employee and sell it somewhere. I bet you could find someone to purchase the note.
Interesting. That is really interesting. Now, another way that I've seen MSPs that are really strapped for cash is selling off their AR, I think is what it's called, or there's factoring. I think those two are slightly different. Or maybe they're the same thing. I don't know.
They're very similar, but yeah, I mean, one is basically just borrowing against your AR, so or the other is selling. So, but they're very similar, where you're collecting receivables and then getting cash for those receivables. I mean, ideally, we have clients that don't have receivables, right? They're getting paid up front for their services. They're getting paid up front for whatever equipment that they're purchasing and turning around and providing to their customers. And, the only AR that they might have might be, half of whatever project the MSP might be doing for them. The half that they didn't collect up front would be the only receivable. So ideally, you want to stay away from the receivables if you can.
Yeah. Yeah. I feel like factoring and selling off AR, that type of stuff is kind of like those payday loans.
It's not cheap debt.
Well, it's not cheap. And when I've seen people do factoring, it's when they do business with like big companies that pay on long term, net 90, net 120. And so they need to still function their business.
Mm-hmm.
And if they have a PO from a big company, they can get that factoring, right? Like it's a pretty sure they're going to pay. Whereas like if I go and I say I have Joe Smith coffee shop down the corner and I want to factor against it, that's not like a reputable company. It would be, I don't even know that I would get it. So I think it's geared toward people who are doing business with really large companies and they're paying on long terms.
And that's really good. I always think of the negative, right? I always think of, what kind of predatory scam are people running with this nonsense? And that's what I think of when it comes to payday loans. I feel like they're taking advantage of people who are in, are just a real crappy situation, or maybe aren't educated enough to understand that it's a really bad deal or whatever, right? I guess I didn't think of factoring as a way to help you, because you're doing big business with crazy 3, 4, 5 month terms. I can't imagine letting somebody not pay me for half a year, or a quarter of a year.
It's your like, it's what do they call it? Like the advantage is you're doing business with. They could go do business with another vendor. So if you want to do business with this company, you're gonna get these are the terms we're gonna give you. And
we have a client that did a project for a major multinational corporation, and the terms there were, you do the project, we'll pay you in 90 days, right? So there was a lot of, there was 120 days. So there was a lot of upfront costs for that project. And, the owners of the business went out and got lines of credit so that they could fund the cost of the project. Other things, if we recommended to them was, the company has a 401k. If you have the ability to borrow against your 401k, maybe that's a way to get some additional liquidity. So
how does that work?
Yeah. So the rules on borrowing against your 401k is, assuming your 401k allows you to borrow from it, the maximum amount that you can borrow from your 401k is 50% of the balance, or $50,000. So it's just, it's a way to get some cash if you have a balance in your 401k. If you don't have a balance in your 401k and you have an existing IRA, you could, again, assuming your 401k will allow you to do this, you transfer your IRA balance over to your 401k, and now you can borrow against that.
That's really interesting. And I guess I just want to clarify, are you talking about the business owner's 401k, or are you talking about the employees, like being able to mess with their 401k?
Oh, no, it's the business owner. So yeah.
Okay.
Yeah.
I was going to say, man, I'd love to gamble with other people's money. Let's do
that. I'm pretty sure you might go to jail with your bar.
That's not fair. I don't think you could get access, because once you make the contribution, it's in their account. I don't know.
Exactly.
I don't know. I know a guy.
Oh, there's shady versions of, payday loans, yes, those are shady in general, but I'm sure there's shady versions of the factoring program, right? There's probably like people who will give anybody money against any receivable and charge them a huge interest, right? Like, of course, you can take anything and make it, but I do think that it can be legitimate in speaking.
So every now and then, I'm sorry, Morgan. Every now and then, I get a random, and I'm gonna not even talk about the ones that are text messages. I'll get a random email letting me know that Taylor IT Group, my MSP that I ran, is eligible for a loan of up to $100,000. Are those like spearfishing campaigns or something, or are these actual companies that are trying to just market and using whatever shady technique they can use to try and get customers?
You're trying to get your social security number.
Okay.
I was going to say, Steve, that, all these things that we're talking about, outside of cash flow from operations. So if you're talking about taking on debt or taking on any of that stuff, hopefully MSPs are monitoring their cash flow and are seeing, a month or 2 months out, like, hey, I might have cash flow needs a month or two from now, and not get yourself in a situation like our client was, where like, hey, I need to get this loan like tomorrow. Otherwise, I'm not going to be able to take on a project, or my business is going to go under, or I can't make payroll because I don't have cash, right?
Mhm.
You really need to start looking out into the future and identifying, hey, where are some soft spots in my cash flows, and planning for how you're going to fill those soft spots before you're already there.
Let's talk about forecasting. Forecasting, I feel like that's reading the tea leaves in my mind, because I don't know. I'm sure it's very scientific and mathematical and it works, right? But I've never done it. I'm very much a fly by the seat of my pants. I think that's the right way to say that. I shoot from the hip, right? I'm not a planner. And I think, Morgan, you said to me earlier, and I've heard it before, if you fail to plan, you're planning to fail.
Yep.
So, that's very much me.
Well, when it comes to forecasting and when it comes to cash flow forecasting, pretty much, your monthly expenses. Of course, there could be random things that come up, but so it's planning for those operating expenses, your payroll, your rent, your regular monthly operating expenses, and what you expect to bring in. So you have agreements that are signed agreements and everyone's paying you monthly on the first. That's, you can count on that cash flow. If you're sending invoices and hoping people pay, you can't count on it, so it's harder to forecast. So it really depends. You have your system set up, you get your clients to pay, have a payment method on file, pay in advance, all the things that help you understand when the money's coming in. The money going out is pretty predictable. And that way you can see how long, where is a problem? In 3 months, will I have a problem? In 6 months, will I have a problem? Much easier to see when you have autopay, people paying you predictably. Harder to do when you're putting invoices out into the universe.
Yes.
Think about it like your household expenses, Steve, right? Like, that you're going to get paid on the 1st and the 15th. Your mortgage payment's going to be due on the 1st, and all those expenses, right? If you're self-employed and you don't know when you're going to have income, yeah, it becomes more complex, right? So, if you're someone who is not sending invoices and getting your clients to pay you on the 1st of the month, it's much easier to project out what your cash flows might look like.
I gotta say, and I've probably said this before on an earlier session, but I use a bank personally called Cube, QUBE, and it has changed the way I manage my money completely. It's basically like the envelope budgeting system, where every dollar has a job, right? And you set up all these cubes, they call them. Here's my electric bill, here's my Netflix bill, so on and so forth. Every cube has its own bank account, and its own debit card number. And I can tell it when the bill's due. So that way it now sorts them all in the order. So that way I can make sure they're all funded correctly, et cetera, right? So are you aware of something like that for people who maybe just need a better visual for business?
There's a profit first method, which is sort of like that, which is like you open bank accounts for your profit, for your taxes, for your payroll, multiple accounts. And then whenever you get money, you split it, or once a month, you split it between those accounts. So that's done. There's a book of thing called Profit First. So that's what that is. I don't know of a bank specifically that would do that, but it's definitely done in business. Relay-Fi. There you go.
I'll have to check that one out. The only one that I could think of that's kind of close is Mercury, Rafi. Have you guys worked with any Mercury users? Mercury's cool, man. So it's free checking, and they've got you can make however many accounts you want. You can label the accounts. You can give debit cards to whoever you want within the company. You can give them access to only certain accounts. You can even create virtual debit cards. So I was basically doing that with Mercury, but it was a lot of work because they didn't have those budget like features, right? It was all very, very manual. So I'll check out Relay-Fi. That looks cool for the business side of things.
Ramp isn't a bank, but it's where it's like a payable system, and you could do the same thing where you can have the virtual cards for different people in the business, set a budget for them, give them a monthly budget.
Very cool.
Yeah.
Yeah, we use Ramp here. So, I've got my marketing Ramp, and I've got, a few different Ramp cards, and I really like the way it works. It makes it very easy for us to, just manage all of our expenses and not have to put it on, my credit card and then expense it and then wait 3 months for them to get around to paying me. And because they're doing their own cash flow management, right? Is that a thing? You delay paying your employees because cash flow management?
Never.
And our employees. I'm sure people do it.
I just want to clarify. Baxter's a great guy. He has not done that to us, okay?
I can't imagine many employers do, and if they do, that's one way to get your business to go down pretty quick, is not pay your employee.
Well, and I guess I was thinking more like expense reimbursement, not necessarily payroll. So,
I mean, I don't know how much your reimbursements are, but if they're that much that they can help the company's cash flow, I think you should. I don't know. You should get a company card.
let me tell you, it some past companies have been very poor at that. We're not going to name names. Let's talk about investments. What kind of investments can or should businesses, obviously MSPs, be making with some of the extra cash they've got laying around? Like, obviously they want to have a reserve for a rainy day, but then they should take some of that extra money and, like, I don't know, what's on the stock market, right? Or they
Themselves, right? Isn't that where you start a business, to pay yourself?
yeah.
Yeah.
But
I mean,
it's not give yourself an owner's draw or a bonus. It's, invest in your future, right?
yeah.
Right.
So, well, I mean, the what we commonly see right now in the MSP space, and maybe it's been for a while, is, they all want to go out and buy another MSP or grow their business. Those that aren't interested in that, they're just, fine with where their business is, how do you get cash out of the business? in a tax efficient way, right? So, one of the ways that we talk to our clients often about is, make sure if you have a 401k that has a safe harbor plan, consider doing discretionary profit sharing contributions, right? So that allows you to put a pretty significant amount of money into your 401k. The business gets a tax deduction for it, and you end up obviously with a bigger 401k balance. So
What is a safe harbor? Can you talk to me about that?
yeah, so 401k plans, and there's a bunch of rules around top heavy plans. So you don't want heavily compensated people basically mistreating employees, right? So what the safe harbor plan does is it's typically like a 3% match on everybody's salary. And that gets you out of the testing rules for the top heavy requirements for a 401k. If you have that in place, then you can do discretionary profit sharing contributions. And those profit sharing contributions need to be paid to everybody, right? But your employees will get a smaller amount and you'll get a bigger amount. And the maximum amount that you could contribute to your 401k is around $70,000. So the employee would do their contribution, the 23,500, and the business would put the remaining in. And that would be a tax deduction of the business, and you end up with another, 40 something $1,000 in your 401k.
That's awesome. I like that.
Oftentimes what we see is people will take these distributions and then they'll just put them in the Schwab account, in a Schwab taxable account or a Fidelity taxable account. It's like, well, why don't you just do a profit sharing contribution in your 401k? You would get a tax deduction for it and then tax deferred growth on the 401k.
Hey guys, we've got 20 minutes left. We're gonna end at the top of the hour, unless we end sooner. So if you have any questions, specifically around accounting or cash flow management, please pop them in Q&A, or since the chat is moving slow enough, you can pop it into the chat as well. What other types are there ways that the business can invest its money without necessarily leaving the business? So like, can I put it in like something better than a high yield savings account?
Yeah, you can do a CD.
Okay. Do people still do CDs?
Yeah. But you can get a similar interest rate on a more liquid investment, right? Like a money market fund or something like that, right? It's pretty safe. I would suggest that unless you have a lot of cash, if you're really focusing on cash flow and you might have cash flow needs, putting it in a stock market or something like that is not a great way to go, because stock market goes up and down, right? So down the road, if you need the cash and the market's down, you're probably gonna lose some money. So a safer bet is to do something like a money market fund or a CD, or do a CD ladder even, where you're putting it in different terms, and the CDs are maturing at different terms. That's not a bad way to go either. After you pay down your debt, of course.
Oh, stop talking about paying down my debt.
What? One thing I was going to say is don't keep debt on credit cards, because credit card interest isn't
It's only 39%.
only 50. You need to keep carry debt, get a different kind of debt. I can't do that.
All right. All right. So when I think of cash flow, my thought, when I ran my MSP, I always worried about one thing: money in greater than sign, money out. Right. So that was all I worried about. And if I was doing that, I was winning. But there's probably more nuance to cash flow than that, right? Like,
Well, it's important to look at money in and money out. It's important also to look at what money is coming in and what money is going to be going out. It's not just now, like Morgan said, you've got to be able to look in the future, because if you're focusing on your P&L and that's what you're looking at, then you don't know that you are not running out of cash, because a P&L is just, how much you're invoicing, right? It doesn't reflect how much cash you brought in. So it's important, one, to look at your balance sheet also, but also look at cash flow and look forward in cash flow.
Okay. KPIs or whatever metrics we want to think about, right? What would you say are the top few? I'm not going to limit you, but what are the top metrics that every MSP, no matter what size they are, that they should be monitoring, and how often should they be monitoring them?
Are you referring to specifically cash flow KPIs or?
Yeah.
So the EBITDA is one that would, out from a cash flow perspective, you want to be watching. Free cash flow. So yeah, I mean, and there's other KPIs that are out there, like your current ratio and stuff like that. But if you're talking about cash flow, you're really focused on, free cash flow and EBITDA probably.
Okay. Would you say that there are any other KPIs, maybe outside of cash flow, that, like, okay, if I look at my EBITDA and it's you usually look at it and say, all right, I've got a 10% or a 22% or whatever, right? So if I look at that, are there other KPIs I should be associating with that to get a bigger, better picture of my business health?
One would be, if you have receivables, like how long are those receivables outstanding? So the days receivable outstanding would be a good one to keep your eye on. Obviously, the shorter the receivables outstanding, the better. So you want to focus on trying to shorten up those days that your receivables are outstanding. Lengthen how long your days payable are outstanding, right? So again, you don't want to be getting an invoice in the mail and sending the check out the next day if you don't have to. And so print.
Can't let go.
Oh, yes. Their ACH, yes. Your bank transfer, whatever. So you want to shorten up the receivables and lengthen out your payables so that you have sufficient amount of cash on hand.
And client concentration is something that's super important to look at, like not having too much of your revenue tied up in too few of your clients. So I think that's a huge thing to keep an eye on. If someone has one client that's 70% of their revenue, that's super risky. I think keep a close eye on.
Very good. What do you have any other words of wisdom that you would like to impart?
I'll give you one word of wisdom is make sure you're keeping your books up to date. Shameless plug for Stride, but even if you're not using Stride, make sure you keep your books up to date. If you're scrambling around this time frame to do last year's books, you're not in a great spot. You should be keeping your books up to date as often as possible. So, I always tell people, I'm a tax guy, right? Like if you hand me a crappy set of books, you're going to probably get a crappy tax return or a big bill for me to fix everything. So keep those books updated.
I talked to somebody this morning and he said, oh, I won't have my 2024 tax return until much later in the year. And I was like, oh, really? Okay. And then I asked him, and he said, isn't that all businesses? All businesses have to get an extension. And I was like, no, most of our clients have had their tax returns filed already. Or they're ready to be filed. We close every month. And so closing December is another month. And we're ready to file taxes in January, end of January.
Yeah, it's March 6th. If you haven't done your taxes yet, get your butt in gear.
Or get that extension done.
And if you haven't done your books, you're even more trouble.
Yeah.
Can you give us the elevator pitch? What does Stride do for MSPs?
Stride helps MSPs get out of the way of getting their accounting done. So Stride gets the bills out or the invoices out to the customers. We get the bills paid to the vendors. We manage payroll. We will set up a payment system for you to get your clients on ACH, get them away from paying by check, and help you eliminate your receivable. We'll also make sure you're paying the right amount of taxes on a quarterly basis versus being surprised at the end of the year.
Perfect. And I see that just about everyone that answered the poll is an alternative payments customer. So I'll keep it brief. Alternative payments is a payment portal for MSPs, so that way their clients can pay them electronically. So if you are not doing that today, reach out to us, alternativepayments.io. All right. Well, Becky, Morgan, this has been fun. Thank you very much for hopping on here and doing this with us. Guys, if any of you are interested in reaching out to Becky or Morgan, you can go to www.stride.services, and that is their website. I'm sure they've got a contact page and all that good stuff. So thank you so much. Our next session will be on March 20th, and we're going to talk about some MSP financials. We're actually going to look at some real financials from real MSPs, and we're going to talk about the good, the bad, the ugly. So definitely register for that, and we'll see you then. Take care, everybody.
Bye all. Thanks, Steve.
Thanks, Steve.
Thanks, guys.